So we'll continue to take a look at names on the move. Joining me right now, Diane King Hall, host of Morning Movers, and looking at Datadog shares and more than 45% up off the April lows. And we did see a Wolfe with a call today.
Yes, they are upgrading their view on Datadog, upgrading it to more constructive. They're raising it to outperform from peer perform. This is by Wolfe Research. Their new price target is $150 a share. They think that Datadog is better positioned than they previously thought to capitalize on AI demand. So you're seeing shares move up a little more than 2.5%. This follows the momentum from their the Dash user conference that was in New York, where Wolfe said they saw improving customer sentiment, I should say, and they saw promising AI-focused product launches. Datadog introduced tools like Cursor, Codex, and that's expanding beyond their core AI development support. They see their AI client base growing. There had been some concern about over-reliance on just a few AI clients. But now they see that 17 of the top 50 AI companies using Datadog. They think that helps dissipate fears about just concentrated exposure. They surveyed more than 100 Datadog customers, 150 to be precise, and they like the trends that they are seeing. They see platform usage rising. They're modeling now mid to 20% annual revenue growth. The AI-specific business, they're expecting that to grow at a compound rate of 88%. So Wolfe Research believing that even though the stock is down year to date, it had been down before today more than 15%. They don't think that reflects the growth trajectory here and the margin profile. They're raising their guidance and their view on that. And the company, you'll recall, had their 2025 guidance projecting 20% revenue growth. So again, essentially, Wolfe Research sees this as undervalued here.
Interesting. I mean, Needham has that buy at 140 of the 150 from Wolfe, as you noted. When you think about software and all of these types of names, there has been an appetite for this group overall, right?
There has, but Datadog has been an underperformer year to date. But again, it's getting a lift today. Shares continuing to rise as we speak, up almost 3% right now off the back of this upgrade from Wolfe Research.
All right, next up, we're looking at Palantir. I see Loop Capital with a call. You have some calls from Citi and the like. Palantir, an incredible chart from $21 up to $140. Still going, I guess.
I know.
I don't know. You
right?
Tell me.
Look, the stock is under a little bit of pressure today, off by 0.5%, but it touched a new all-time high yesterday, so it's really continued to be an outperformer. But there have been questions about its valuation. Is it justified? Citigroup is still on the sidelines. They're maintaining their view to neutral view on Palantir. This comes after Citi analysts met with the CFO of the company. They see some positives, but they also have some concerns. Citi says they do like the fundamentals when it comes to Palantir, and so they have an upbeat view on that. But they have concerns about how that stock can grow into its valuation, especially if the magnitude of positive revisions slow or large contracts like the Golden Dome don't materialize as expected. So they've got a $115 price target on Palantir. And, look, it's the valuation, again, continues to be just a flag. We'll call it a yellow flag, especially when it comes to Citigroup. It hit that 50, it hit a new high yesterday. It's got a PE ratio of more than 500. Many point to that. It's just a very, very rich, expensive valuation. And it's just hard to justify it. Even though they do have these contract wins, strong contract wins, whether we're talking about the government side or the commercial side, they have seen more growing adoption of their AI platform, AIP, especially when it comes to financial services. So Palantir, still has strength in their businesses, but again, the question is it too rich, has been the question for many analysts around it.
And there seems to be a lot of questions about what Palantir's revenues and what it really does. I mean, there's the clear government contracts part, but there seems to be a bit of uncertainty about some of Palantir's business, but we know Dan Ives has been right on this. He loves Palantir. Called it the Messi of the group. I mean, he's been so hot on this name and has certainly watched it surge to these record highs. So it's been an incredible run. I mean, not too many stocks are up nearly 500% in 1 year.
Yeah,
right?
and to be fair to Dan, I mean, his thesis has proved true when it comes to Palantir. They continue to secure these government contracts. They had a recent win with this NATO deal. They have, promising growth when it comes to the Middle East. They do face some headwinds when it comes to Europe, but overall, Palantir has been doing well, especially when you think about, both the growth in the government and the commercial. The government was its bread and butter previously, but it's had faster growth, more rapid growth in commercial recently.
All right, next up, folks, Tapestry, a winner year to date. I mean, there's not too many names even that have a 25% gain this year. Tapestry certainly has done an incredible run, and I'm seeing some analyst calls that you're covering too. Yeah,
look, this is a play on affordable luxury is what we'll call it. Tapestry, the parent company of Coach, Stuart Weitzman. So TD Cowen is out with an upgrade to their view on Tapestry. They're upgrading to a buy from a hold rating. Their new price target is $100 a share. That's up from $90. So that certainly implies, if we think about yesterday's level, it implies that we'll call it more than 20% upside from yesterday's level. They see strong momentum at Coach. They're also optimistic about the footwear and just brand heat. That's a quote based on their customer surveys. They're estimating about 5% growth for Coach in fiscal year 2026. They think Coach is benefiting from both its just strategy and then the expansion in the product family, lifestyle assortment, and then stronger full price selling. So in other words, they don't have to discount. They can sell the items at full price. They also see an opportunity in footwear as a growth driver there. They see $1 billion opportunity there. They think that could generate in revenue. And then Coach, they said, have been introducing uniform pricing across both their full price and outlet stores, so that creates this brand consistency. Even though, usually when you go to the outlet for Coach, you're looking for a better deal there. So, I don't know, I'd hope to see a good deal there if you're going to the outlet. But Coach really has the leverage when it comes to pricing. And, as we've talked about this recently, they've been popular in the ecosystem. They've got the it bag. TD Cowen has talked about, how Gen Z, when they look at their channel checks, has been leaning into this. Their marketing flywheel, they see that as just really powering momentum when it comes to, and we've talked about how the luxury market has lost some ground, like say LVMH, so they're losing that ground to Tapestry.
The competition is fierce. We're looking at Phillips Van Heusen, PVH, Ralph Lauren, Capri. When you look at these names, Michael Kors' parent is Capri, and Coach, Ralph Lauren, Macy's have been taking prices up on select items, according to this article. And Capri has Jimmy Choo, but they said in some cases, some of the demand for certain items selling is a bit weak. So how are they going to take up prices or offset some tariffs, if any? There's still some uncertainty on how they'll handle that.
There is still some uncertainty, but the thing again with, as you know, in this space, a lot of times is if you have the it bag, if you have, you're the popular, like for instance, when we think about the shoe space and we think about Hoka and On, although they've lost some ground this year and are concerned about some tariffs, they had been the leader. So right now in this space, when we're talking about affordable luxury, it is Tapestry, it is about Coach. You've got another analyst upgrading their price target as well. Wells Fargo raising their price target as well to $100 a share. So that matches the move that we see by TD Cowen today. They are overweight. They're maintaining that overweight rating for Tapestry. So this is the year for Tapestry. Telsey is maintaining outperform as well. They've got a $92 price target. Barclays also overweight. They're raising their price target to $98 a share.
If you have the hottest item, people will pay anything for it. And and that's really the final thought. Look at what people used to remember: Cabbage Patch Dolls and Tickle Me Elmo.
Yes.
I mean, people were willing. The PlayStations. When something is hot in retail, it's priceless. Everybody wants it. Diane King Hall, thank you. Good to see you. Thank you. Good 3 names there.